On the surface, the American economy in 2025 looks invincible. On Wall Street, the music is playing loud. Stock markets have shaken off the shocks of a global trade war to reprise all-time highs. The S&P 500 has broken records. Fortunes are being made in a blistering rally, driven by the seemingly unstoppable power of artificial intelligence. To the casual observer, it's a picture of supreme confidence. But behind this dazzling spectacle, something deeply unsettling is happening. It's a crisis that doesn't make the headline news, a tremor in the very foundations of the global financial system. While everyone is watching the stocks go up, the US dollar itself is in the middle of a silent crash. So far, this year, the dollar has dropped more than 10%. This isn't just a minor fluctuation. If the trend holds, it would make 2025 the weakest year for the world's dominant reserve currency in more than 2 decades. And it's not just falling against one or two rivals, it's carving out declines against every other major currency on the planet. This presents a profound paradox. How can the world be simultaneously rushing to buy American assets while running away from the American currency? What do the world's largest investors see that the rest of us are missing? This is the story of that paradox. It's a story about a hidden vote of no confidence in the United States, and it reveals a deep anxiety about the future of global power. Part 1. Unmasking the Silent Crash. The first thing to understand is that this isn't a classic market panic. We are not seeing a mass rush out of U.S. assets. The buoyant stock market kills that idea pretty comprehensively. Global investors still want a piece of the action. They want to buy into the fast-growing companies, especially in the dominant U.S. technology sector. They are, as the old saying goes, getting up to dance as long as the music is playing. So if they are still buying American stocks, how can the dollar be falling? The answer lies in a financial strategy that has suddenly become the default for global capital: currency hedging. For those unfamiliar, hedging is essentially a form of insurance. Imagine you're a European investor buying shares in Apple. You're betting on Apple's stock price to go up. But you're also, by default, betting on the US dollar. If Apple's stock rises by 10%, but the dollar falls by 10% against the euro, your profit is wiped out when you convert your investment back home. To prevent this, you can hedge your currency exposure. This means you make a separate transaction where you effectively sell US dollars in the futures market. By doing this, you isolate your bet. You are now purely betting on Apple's stock performance without being exposed to the fluctuations of the dollar. You've separated the company from its currency. And right now, foreign investors are doing this at a staggering, unprecedented rate. According to a striking analysis by Deutsche Bank's George Saravelos, foreign investors are now removing dollar exposure at an unprecedented pace. The data is astonishing. For the first time this decade, hedged financial flows into U.S. exchange-traded funds, one of the most popular ways to invest, are outweighing unhedged flows. The switch is described as exceptionally stark in stocks, where more than 80% of inflows are now hedged. To put that in perspective, at the start of the year, the hedged portion was close to zero. In the bond market, too, the hedged tally is running at about half of the total. Let that sink in. The vast majority of new foreign money entering the U.S. stock market is now accompanied by a direct bet against the U.S. dollar. Investors want the assets, but they are actively dumping the currency. This is the silent crash. It's a massive, coordinated move by global capital to insulate itself from America's currency, even as it feasts on America's corporate growth. The question is, why now? Part 2. The obvious suspect: interest rates. The relatively dull textbook explanation for this phenomenon is interest rates. Currencies are, in large part, driven by the hunt for yield. Money flows to where it is treated best. When a country's central bank raises interest rates, its currency tends to strengthen because investors are rewarded with higher returns for holding it. Conversely, when rates are cut, the currency tends to weaken. And right now, we are seeing a major divergence in the paths of the world's central banks. This week, the U.S. Federal Reserve made its move, lopping 1/4 percentage point off its benchmark interest rate, the first cut of the year. Meanwhile, many other major central banks are signaling that their own rate-cutting cycles are at or close to an end. When interest rates in different countries start moving in opposite directions, currencies tend to follow suit. But the Fed's move isn't happening in a political vacuum. The central bank has been under immense pressure from the White House to aggressively lower rates to boost growth and reduce the government's borrowing costs. The extent of this pressure was laid bare in the Fed's own projections, the so-called dot plot, which shows where each rate setter believes rates should be in the coming months. This week's plot contained a conspicuous outlier. One dot was radically lower than all the others. It's widely believed to belong to Stephen Moran, President Trump's latest appointee to the Fed. Moran was the sole voter for a larger half-point cut in rates this month, and his dot pencils in a whopping further 25 percentage points in cuts over the rest of this year alone. With only 2 scheduled meetings left in 2025, that implies seriously chunky, crisis-style rate cuts at each meeting. Moran is unlikely to get his way for now, but as a statement of intent for what a fully Trump-controlled Fed would do, it is powerful stuff. Global investors see this. They see a central bank whose independence is being challenged, and they see a clear political desire for a weaker dollar and dramatically lower interest rates. From a purely financial perspective, betting against the dollar in this environment seems like a logical move. But it's only half of the story, because the fear driving this silent crash runs much deeper than monetary policy. Part 3. The real fear, a crisis of confidence. Here is the crucial detail that complicates the simple interest rate narrative. Those dollar hedging rates locked up way before rates started to fall again this week. The unprecedented move to de-risk from the dollar began before the Fed even made its first cut. This tells us that something else is at play, something more fundamental. This is not just about yield. This is about risk. The dollar's extraordinary status as the world's reserve currency isn't just built on economic might. It's built on trust. Trust in America's institutions. Trust in its rule of law. Trust in the stability and predictability of its political system. For decades, the US dollar was seen as the ultimate safe haven because the United States itself was seen as the ultimate safe haven. That perception is now eroding. The hedging frenzy is a grim signal that investors fear institutional damage in the US, with all the volatility and long-term economic cost that entails. It's a quiet acknowledgement that the political paradigm shift now emphatically underway in the US is making the country, and therefore its currency, a fundamentally riskier proposition. After years of a president chipping away at institutional credibility, the world is beginning to price in the consequences. This anxiety isn't just visible in the arcane world of currency derivatives, it's also showing up in the oldest barometer of fear there is: gold. At the same time investors have been hedging the dollar, the price of gold has been soaring, blasting through to new record highs this week. This is no coincidence. A flight to gold is a flight from fiat currency. It's a bet that tangible, stateless assets are safer than currencies backed by governments and institutions whose credibility is in question. The world's most sophisticated investors are now openly modeling for scenarios that were once unthinkable. The Dutch asset management house Robeco, in its latest 5-year outlook, assigned a 35% probability to a scenario they call exorbitant decay, a total unraveling in the global financial order. Their model describes a self-inflicted, preventable sidelining of multilateral bodies and national central banks, ushered in by the US. Let's be clear about what this means. A major global financial institution now believes there is a 1 in 3 chance that the United States itself will trigger the collapse of the very global system it created and led for nearly a century. This is now widely seen as a serious possibility. This is the real fear that is haunting the currency markets. The spectacular rally in U.S. stocks is built on the narrative of technological transformation and corporate profit. But the silent crash of the dollar is built on a counter-narrative of political risk and institutional decay. The lesson, as Katie Martin writes, is that the impressive recovery in stocks is masking deep anxiety from investors about the path forward. Conclusion: what comes next? We are left with two competing stories. One is a technical story about interest rate differentials, a normal part of any economic cycle. The other is a much larger, more troubling story about a crisis of confidence in the long-term stability of the United States. The evidence suggests both are true, and they are feeding off each other. The political pressure for lower rates fuels the narrative of a weakening currency, while the fear of institutional decay gives global investors every reason to seek shelter from that weakness. They are still willing to come to the party on Wall Street, but they are packing their own life rafts just in case. For decades, the world has operated on the premise of America's exorbitant privilege, the immense benefits that come from printing the world's reserve currency. It allowed the U.S. to borrow cheaply and wield enormous geopolitical power. What we are witnessing now might be the dawn of an exorbitant decay, as one analyst put it. The slow, painful erosion of that privilege. For now, the buck stops with the buck. The dollar remains the bedrock of global trade and finance. But the tremors are growing stronger. The silent crash in the currency markets is a warning shot, a signal that the world is beginning to imagine a future where America's currency, and by extension, America itself, is no longer the only safe bet. The question that remains is whether this is a temporary, cyclical storm that the dollar will weather, as it has many times before. Or is this something different? Is this the beginning of a permanent structural shift in the global order, the first chapter in the long, slow decline of the dollar's reign? And what would a world like that even look like?